So we're looking at cash flow statements here. We're looking at the ordinary level question, and it's the fundamentals of this is the same for the higher level. So I'm just going to quickly run through where did I get my numbers from. So how did I actually do this particular question? Now I have the question partially done, but as I go through it, I'll talk you through where did I get my numbers from. So the question is divided into three parts. We've got the reconciliation of profit to cash flow. So I call that the cash from operations, this first part of it. The second part of it is the cash flow statement, which has two parts to it, which first of all is how do we, what bills do we pay, and then how do we finance our business. And then the last part of it is we're trying to reconcile or compare the cash that came in with how indebted we are in the business. So we'll come back to that then at the end. So first of all, we start off with this part here. We start off with the cash from operations, the beginning bit. So we start off with 92 grand. So 92 grand is the amount of profit that was earned by the business. And we're trying to work out from this the amount of cash that came in. Now, it sounds logical that if we made 100 grand profit, then 100 grand of extra cash should be in the bank account. But there are two kind of categories of things that might have happened to cause that not to be the case. So first of all, when we came up with our operating profit, we had non-cash incomes or expenses. So what that means is something was put down as either an income or expense this year that didn't involve us spending cash this year. And depreciation is one of them. The idea of this is that we spent a number of years ago, we spent a large amount of cash buying an item, and we're writing a bit of that off every year as depreciation. So we didn't spend any cash on depreciation this year. We spent it years ago. We spent a large amount on buying the fixed assets. So we're going to take that depreciation out. Depreciation was put in originally as an expense, which would have been a minus, which would have made that profit smaller. So when we take it out, we have to add that number on. And the depreciation figure is found by looking at the difference between the opening provision for depreciation and the closing one. So last year's one was 30,000 and this year's is 40,000. So it's gone up by 10 grand. So that 10 grand was our depreciation. Next, we look for profit and sale of fixed assets. Doesn't happen very often in ordinary level questions. It would have been listed down the bottom. They would tell you, including our profit, we sold a fixed asset for X and we made a profit of. So they would tell you that. So then you would include that there. Now, profit would have been an income, which would have increased my operating profit. So if I made a profit on the sale of fixed assets, then to take that out, I'll have it as a minus. Because when it originally happened, that profit would have increased our profit, our operating profit. So to take it out, we have it as a minus. So other than that, we have what they call working capital items. So these working capital items are changes in stock, debtors, and creditors. Now, I have stock as a -6. Why do I have that? Our stock has gone up by 6 grand, and because it's gone up, it means there's more stock sitting on our shelves, which means more of our cash is tied up in stock. So that means we have less cash in the bank account because we bought more stock. So that's why stock increase means we have less cash. Our debtors have gone down by 3. So that means our debtors, instead of delaying to pay us, they've actually paid up more money. They owe us less than they did before. So that means we must have more cash than we did before. So that's why that debtors decrease is a plus. And finally, our creditors. The creditors have gone up by 6 grand, which means we are delaying paying some of our bills. We owe more money. Well, if we owe it, then that means we must have more cash in the bank because we haven't gone and used our cash to pay for some of our bills. So that's why creditors increase is a plus. And then what I do down here at the bottom, cash from activities or cash inflow from activities is going to be all of these numbers added together. So 92 plus the 10 minus 6 plus 3 and plus 6. So that's where the 105 comes from. And that's the start of the next part of the document, which again I've got partially filled in. So net cash inflow is 105. So that's the cash that came in from our profits for this year. And then first part of the cash flow statement is where we look at some of the big bills we pay, buying fixed assets or selling fixed assets. In this case, we bought a fixed asset for 120. We got that because land and buildings was 180. It's now gone up by 120 to 300. It doesn't say at the bottom question that we dispose the fixed assets. So disposal of fixed assets is going to be 0. We didn't get any cash for selling a fixed asset. We paid £2,000 interest. We're told that interest paid is £2,000, and we're told dividends paid is £50,000. So that's where those two numbers come from. Now the tax paid is the one that does throw people. Our tax is listed as 12, and we owe 12. So these are current liabilities. Creditors amounts falling due as current liabilities. So we had a tax bill of 12, and we owe all 12. We haven't paid any of that tax bill. But what we had last year was we had a tax bill of 10. So this was last year's tax bill that was owing last year, and we don't owe that anymore. And how do we know? Well, that's because this year's tax bill is all of that is owing. So we had a tax expense or charge of £12,000, and we owe £12,000. So that the bill for this year is owed. That's last year's tax bill, which we must have paid because we don't owe it anymore. So that's where the tax paid of £10,000 comes from. It's last year's tax bill. So we look at current liabilities for last year. Now, moving on to the next part of it. Now, what I've done here to get my net cash inflow before resources and financing, I look at, there's the cash inflow, and I've taken all these amounts away, and I end up with a final number of £77,000. So that's before we move money around or before we finance the business. So, starting with £77,000. So the first part of it is, did we transfer money to a different bank, okay, or to a different account? Now, what that might mean is we took money out of our cash. So cash is the money that we have at the moment. So we took money out of cash and put it into a different type of bank account. So it could have been listed up here. There's only two ways we would see this. Up here in fixed assets, you might see a government security or government investment or investment bond, something like that, which gives you, it would say something like investment 6% or government security 8%, something like that. It doesn't say that here. So because of that, there's no, we don't have a long-term investment, or we could have maybe a building society account or a different type of savings account, and it's not mentioned here either. So therefore, in this case, there's no transfer to other types of accounts. So there's no managing liquid resources. So financing. So financing basically is, how did we pay for the £77,000 that we've just paid out? And there's two main ways that a business would pay for it, and we look in financed by, and that's where we're going to get the information from. We either can take out loans, mortgages, debentures. So a debenture, just so you know, is a loan that doesn't involve spending cash this year. Sorry, it doesn't involve buying property. Sorry, my mistake. So debenture is different to a mortgage. Mortgage is a long-term loan to buy property. Debenture is a long-term loan to buy anything other than property, like maybe a large crane or something like that. So in this case, our debentures have gone up by 10. So I'm going to put them in the wrong place. So debenture increase. So it's gone up by 10 grand. And then we look at capital. Okay, or you could say that shares were issued. So in this case, we had 180 grand worth of shares. Now we have 250. So that means a total of 70 grand was issued in shares. Okay. Now, in this case, that means before we financed the business, we were negative 77. We got 80 grand in from finance. So that means in this case, there isn't a decrease in cash. There's an increase in cash. So during the year, we had an increase of cash of minus 77 plus 80 gives us an answer of 3 grand. So cash has gone up by 3 grand. And the proof of that is we compare the amount that was listed in cash or it could be a bank account, okay, that was listed here as a current asset, current liability. That figure has gone up from 12 at the beginning to 15 now. So that means it's gone up by a total of 3 grand. So that's, in this case, that's the increase, the overall increase in cash. Okay, so that's the second document on the cash flow statement, again divided into two parts. The final one then is our reconciliation of cash flow to moving net debt. Okay, so we start off with our increase in cash during the period. So the increase in cash is 3 grand. Now, what has changed during this year? And we're looking at what they call the net debt here, which is our level of indebtedness, how much we owe. Okay, so at the beginning, we're trying to sort out how in debt were we in terms of how much we owe and how much we have in cash at the beginning and at the end. And so we start off by looking at how things have changed. Has anything happened to cause us to be more in debt during the year or less in debt during the year? So the first thing is that we've debentures here. So our debentures have gone up by 10, so we've got an increase in debentures. Now that has gone up by 10, so that means we're 10 grand more in debt than we were at the beginning. Okay, and because we're more in debt, okay, that's a minus number. Okay, so we have become more indebted during this period for that. The one other thing that could possibly happen is maybe you might have taken money and put it into different bank accounts, which might be a plus situation. So we've saved more money, so we're looking for something like that, and I don't see that happening here. So that means that the change in net debt is that number plus that. So we're now 7 grand more overall in debt than we were at the beginning. So we then look at our overall net debt at the beginning of the year and the net debt at the end of the year. So, and this is just a proof, a bit like we had a proof in the previous document. So at the beginning of the year, we had 12 grand plus, okay, so that's not debt, that's savings. So we had 12 grand in the bank account and we had a loan of 10 grand. So that means a debenture of 10 grand. So take those two away because that's a minus, that's a plus. So that means we were plus 2 grand at the beginning of the year. At the end of the year, how are we? We've got 5 grand in cash, 15 grand, here in cash, and our debentures, which is a minus number, okay, is 20. Okay, so that's 5 from that, 15 taken away from that ends up with a number of minus 5. So we've minus 5, so we're now 5 grand more in debt than we were. So the movement in this net debt, we started off being overall a plus net debt of 2. We finished off with a net debt of minus 5. So the overall movement in net debt, it's got worse by 7 grand. So that number we want to match up with the change in net debt figure that we have above, and the two of them do in this case. So that's the proof that we've got this last part of it done. Okay, I hope that makes a bit of sense.